one thing that is true is that even the percentage of illicit activity as a total of all crypto activity is a few percent, in terms of total proportion, the amount of illicit activity on crypto is about 3,000 times more than the amount of total of worldwide financial flow, which is a few quintillion.
What's especially alarming is the involvement of DPRK linked groups, North Korea, terrorist financiers, and a wide range of scammers, of course. According to the FATF report, involves the use of dormant accounts or wallets that sit inactive for long periods before suddenly moving large sums of money, often through mixers or privacy wallets. Dormant accounts should be subject to transaction restrictions, firstly. Secondly, re-verification of customer identity before reactivation, and enhanced monitoring for unusual activity.
So it looks fairly innocuous, right? If you look at the amounts, and generally legacy and really old transaction monitoring systems are not equipped for multivariable analysis, and they're really going to pick on one single item. But if you have a proper and sophisticated transaction monitoring system integrated into your banking transactions, a lot of information that can come up for you to be able to make a reasonable decision as to whether or not this requires further review.
Again, from the practical perspective, each bank in the Baltic at least they're trying to build up their own list and trying to monitor it. An example, it can be something like 500 euros transferred to Coinbase with consistent partners, or if you want to identify structuring, as it was previously showed by Faisal, so a series of sub-threshold transfers should be recognized or identified. And of course, it depends on the jurisdiction. They have 4 steps how to determine the origin of client funds derived from crypto assets. So very interesting read. And only 5 pages.
We need to sharpen our focus on transaction monitoring, wallet activity patterns, and cross-chain behaviors when it comes to stablecoins. Hello, everyone. I believe that quietly everybody has joined, some of you at least. But let's start with the introduction to our new event. I'm happy to welcome you, everyone, to our second collaborative event with Complytek, and now covering a very interesting topic from traditional to crypto banking, as we see lots of traditional banks now adopting crypto products, especially in Europe and especially in light of the new MiCA regulation. Quick introduction, Complytek is a RegTech provider offering a centralized AI-powered customer lifecycle management platform that covers all KYC and AML needs, onboarding, risk assessment, transaction monitoring, case management, and reporting. And Faisal will be covering this from the technological perspective, how banks and crypto asset service providers could leverage technology to mitigate the new risks landscape. My name is Andrei Sribny. I'm the CEO of AML Certification Center, a global provider of practical AML certification and training. I'll give you a brief introduction later on of who we are. And I'm accompanied today by Faisal Islam. He's the CEO of Complytek, a RegTech company I've just gave introduction on. With 10 years of experience in financial crime prevention, Faisal advises on counter-terrorism financing at the United Nations and regularly speaks on crypto compliance and blockchain in regulatory frameworks. And also Viktor Kychenko, who is the head of AML at Citadel Bank, one of the major banks in the Baltic states. He began his career as an investigator at the Estonian Tax and Customs Board. So he has this law enforcement perspective and vision, specializing in uncovering complex contraband networks in Estonia. Since 2010, he has focused on combating international financial crime as a AML expert. And over the past 6 years, Viktor has held key AML roles at major Nordic banks. At Nordea, for example, he led AML and sanctions screening and built the sanctions department from scratch. He later joined SEB Bank to manage international Know Your Customer projects, and currently Viktor heads AML and security department at Citadel Bank in Estonia. driving initiatives to strengthen financial crime prevention across the region. And as promised, let me briefly introduce who we are to any one of you who might not be familiar with us. So AML Certification Center is an internationally recognized and accredited institution dedicated to professional certification and training in the AML and CTF plus or anti-financial crime space. We don't just offer courses, we build a global community of professionals committed to fighting financial crime by organizing different events and sharing the expertise and bridging this gap between theory and practice. So, and our background is rooted in years of experience with respected industry practitioners leading our course and certification development. We use innovative practical methods and deliver training through a user-friendly platform that's designed to make learning experience effective and accessible. Today's agenda looks this way. I will cover the first topic on the emerging financial crime typologies using crypto based on the recent researches by FATF and several financial intelligence units. Then we'll switch to the presentation of Faisal, and he will cover on how technology surfaces high-risk activity in real time. Then we'll switch to the Victor's presentation from the banking perspective on how banks should manage the crypto risks within their ecosystem. And also we'll cover the question of how the bank's view towards the crypto assets has changed over time. And then, as always, we'll switch to the Q&A session, opening the Q&A session with a question. So how banks could adopt in practice the crypto products in their product offering. And then we'll answer all of your questions, guys. And don't hesitate, as always, write your questions in the chat already. If you have some, we'll cover them. We'll make sure to cover them. And after the webinar, every one of you will receive the certificate of attendance to your email. And also we'll send the recording of this webinar to your emails. So stay tuned, be active, ask your questions. It is very important from the perspective of sharing knowledge. Now, let's start with the first presentation, very important one to open this webinar with, because we should understand what are the new financial crime typologies we see, which criminals use with crypto. So let's begin by looking at one of the most concerning trends in the illicit finance landscape today, the growing use of stable coins like Tether by criminals. Stable coins were, as you may know, originally designed to bring stability and usability to the crypto ecosystem. But over time, they have also become a convenient tool for bad actors. We're now seeing them widely used in on-chain illicit finance, particularly because they combine the benefits of crypto, such as speed and global reach, with the price stability of fiat currencies, which is very attractive. What's especially alarming is the involvement of DPRK linked groups, North Korea, terrorist financiers, and a wide range of scammers, of course. These actors are taking advantage of the liquidity and accessibility, as mentioned, of stable coins like Tether or USDC to move funds across borders, often through a web of exchanges and wallets that are difficult to trace. And one common tactic that, according to the FATF report, involves the use of dormant accounts or wallets that sit inactive for long periods before suddenly moving large sums of money, often through mixers or privacy wallets. And this creates a smokescreen that makes tracing illicit activity significantly harder. And for example, as many of you have seen in the media, when the Bybit hack happened, we have seen North Korean hackers launder stolen funds through Tether across multiple exchanges in an attempt to cash out undetected. In another case, a Roman scammer, or many Roman scammers actually, use USDT wallets to quietly withdraw funds defrauded from victims, all while avoiding the oversights typically associated with traditional banking channels. And these cases underline a critical point. While stablecoins offer legitimate benefits to the financial system, they are increasingly exploited by criminals who understand how to manipulate their strength. So as compliance professionals, we need to sharpen our focus on transaction monitoring, wallet activity patterns, and cross-chain behaviors when it comes to stablecoins. Because this is, again, now this is not a future threat or some theoretical threat, it's happening already now. The second one is the role of decentralized finance platforms as crime enablers, a rapidly growing concern in the financial crime circles. So decentralized finance has brought significant innovation as well as the stablecoins to the financial ecosystem. It allows users to lend, borrow, and trade without intermediaries, right? Which is revolutionary. But from a compliance perspective, this lack of central control also creates the perfect environment for criminals. Why? Because there is no central entity to conduct due diligence, monitor suspicious activity, or even respond to law enforcement requests. Criminals have been quick to take advantage of this. They exploit DeFi's openness and anonymity to move and conceal illicit funds with ease. A striking example, fraudsters have used DeFi yield farming protocols to move funds stolen from rug pulls, a type of scam where developers abandon a project and disappear with investors' money, which is a typical scam, investment scam. The absence of gatekeepers in that case means no one's watching or verifying who's using the platform or why. We have also seen anonymous mixing services built on DeFi protocols being used to launder ransomware payments. These mixers fragment and recombine crypto assets in a way that makes tracing their origins nearly impossible. And the challenge for regulators and for obliged entities is also clear. DeFi governance is often unclear or community-based, and the developers may be pseudonymous or even unreachable. So even if there is an intention to cooperate with authorities, there is often no clear route for engaging. And as AML professionals, we need to rethink how we approach risk in decentralized environments. This includes monitoring cross-chain movements, engaging with blockchain analytics tools, which is very important. We'll talk a little bit later about this, and working towards frameworks that promote responsible innovation while limiting abuse. The third one, now let's look at an increasingly industrialized threat, which is scam as a service ecosystems. Just as legitimate businesses benefits from software as a service models, criminals are now embracing scam as a service. These are ready-made toolkits for running crypto frauds sold openly on the dark web or closed forums, which are closed and cannot be monitored by the regulators. They come with user manuals, customer support, and regular updates. It's fraud and fraud commodified in that sense. These tools are powering large-scale scams like big butchering, which is a typical scam, a long con where victims are gradually manipulated into investing more and more money, basically. Criminals now use scripts, fake trading platforms, Telegram bots, and even AI-generated content to maintain a convincing facade. The whole operation can be outsourced and scaled like a business. What's truly alarming is how AI chatbots and deepfakes have taken these scams to the next level. Victims aren't just receiving suspicious messages anymore, they are interacting with realistic avatars, human-like voices, and chatbots that mimic real people with astonishing accuracy, and even created by the AI social media accounts and maintained by AI social media accounts. For example, we have seen investors lured into fake crypto platforms through slick AI-generated video calls, where the scammer appears to be a knowledgeable investment advisor, and all of this happens without a single real human on the scammer's side. This level of sophistication makes detection and disruption far more difficult, and because these scams are modular and sold as services, almost anyone can become a scammer with minimal effort or technical knowledge. Now, our next focus and next typology is a critical threat to both national and international security: terrorist financing through a virtual asset. Please let me know in the chat whether you have seen the new FATF report on the new terrorist financing, their updated terrorist financing risk report. Well, the amounts involved in terrorist financing may seem relatively small compared to organized crime or state-sponsored hacks. The impact can be devastating. Terrorist groups are increasingly using virtual assets not just to move funds, but to microfinance operations, spread propaganda, and build networks of supporters across borders. The decentralized nature of virtual assets makes them attractive for this kind of activity. There are no banks to flag transactions, no borders to cross, and in many cases, no identity checks. That gives terrorist groups an operational edge. We have seen growing use of privacy coins like Monero or other coins, which are designed specifically to obfuscate transaction details, and communication platforms like Telegram, which offer a level of anonymity and ease of distribution. For instance, the growing use of virtual assets to finance terrorism activities is seen within the ISIL-K supporters, and they have repeatedly used Monero and Telegram to solicit global donations, bypassing traditional financial oversight entirely. And the usage of virtual assets for terrorist financing is increasing, especially by ISIL-K groups. What's even more concerning is the rise of crypto-based crowdfunding by lone actors, and these individuals may not belong to an established group, but can still carry out attacks funded through small anonymous crypto donations. They set up pseudonymous wallets, promote causes on social media, and receive contributions directly, often without ever meeting their donors. This trend presents a major challenge for regulators and investigators. Traditional counter-terrorist financing tools rely heavily on financial intermediaries, banks, remittance services, payment providers, but in the world of decentralized finance, those gatekeepers often do not exist. So as compliance professionals, we must enhance our screening for red flags, strengthen our blockchain intelligence capabilities, and work closely with law enforcement and intelligence agencies to identify and respond to these growing threats before they materialize. Let's now turn our attention to a major blind spot in global crypto oversight, like offshore and unlicensed virtual asset service providers. One of the most common strategies used by illicit actors is to exploit jurisdictions with weak or poorly enforced AML laws, as always. These jurisdictions act as getaways for routing dirty crypto flows, often with little to no scrutiny. And criminals are drawn to these exchanges for a simple reason. They don't ask too many questions. There is little or no know your customer verification, no reporting obligations, and very limited cooperation with international regulators. In one ransomware case, for instance, funds were cashed out through an exchange based in a low regulation country, probably even without license, enabling the criminals to bypass stricter enforcement zones entirely. And these platforms effectively become safe havens for money laundering. Another tactic we see frequently is the evasion of the travel rule, which requires VASPs to share sender and recipient information during transfers, which we covered during our previous event, which is a very controversial topic right now, by the way. Please let me know in the chat what do you think about travel rule, whether it's a necessary thing or you prefer, you are on the side against the travel rule, seeing it as ineffective. So criminals avoid this by hopping between unlicensed or non-compliant VASPs, often across multiple jurisdictions, to erase transaction trails and frustrate investigators. So think of it like a money laundering relay race. Funds are passed from one opaque platform to another until they emerge clean or at least untraceable. And this creates major headache for regulators, but it also presents a reputational and compliance risks for legitimate exchanges and regulated institutions that may unknowingly interact with tainted assets. So, which is why it is very important to maintain a whitelist of regulated VASPs you intend to work with. Now we arrive at one of the most visible threats in the virtual asset space, crypto-enabled fraud and theft. At one of the spectrum, we have fraud disguised as innovation, fake crypto projects we've talked about already, often with slick websites and fabricated teams, present themselves as the next big thing. They run initial coin offerings that raise millions only to vanish overnight. And these aren't just scams, they're sophisticated fraud operations designed to exploit investor hype, often leaving no recourse for victims. A recent case involved a fake initial coin offering that promised revolutionary blockchain solutions for healthcare. Within weeks, it had raised over $20 million before the website, wallet address, and founders disappeared entirely. But the other end of the spectrum is even more concerning: nation-state involvement. Certain states are not only turning a blind eye to crypto crime, they are actively engaging in it. The most prominent example is the DPRK, which has been linked to multiple major hacks, including the 2025 breach of a centralized wallet provider, now considering the largest crypto theft on record. And these state-sponsored thefts aren't just about profit. They help fund weapon programs, evade sanctions, and destabilize global financial systems, and all through the digital backdoor of virtual assets. And what makes these crimes especially difficult to combat is that they blend seamlessly into legitimate blockchain activity. Once funds are stolen, they're moved through mixes, cross-chain bridges, and converted into stablecoins or fiat, often before law enforcement can react. If you have seen what happened with the Bybit hack, I believe, if I'm not mistaken, only 3% of the stolen funds were reverted. So the next one is one of the most persistent blind spots in the crypto ecosystem: unhosted wallets, also known as non-custodial wallets. Unlike wallets managed by a regulated virtual asset service provider, unhosted wallets are fully controlled by the user. That means no intermediary, no verification, and no oversight. This gives user full anonymity. But for criminals, it also offers a way to store and move funds completely outside regulated systems. Here's how the risk plays out in practice. A criminal receives illicit funds through an exchange. The moment the funds are in, they are moved into an unhosted wallet, completely bypassing any ongoing KYC or AML controls. And from there, they can be mixed, swapped, or transferred across networks, and eventually withdrawn as cash through OTC desks, for example. And one real-world example involves funds being layered through a private wallet, mixed through a mixer, and then withdrawn at ATMs, for example, or OTC desks using crypto-linked cards or peer-to-peer deals. At that point, it's almost impossible to re-establish a clear chain of custody. Another emerging tactic is the use of cold wallets and QR codes in illicit cash for crypto schemes, particularly in urban centers. The person receives cash in person, scans a code, and transfers crypto directly to a cold wallet. No WASPs, no exchange, and no trace. This poses a serious challenge for regulators and institutions alike. When WASPs are removed from the equation, the safety net of AML controls disappears with them. That's why international bodies like the FATF continue to push for greater visibility into unhosted wallet transactions, including risk assessments and thresholds for WASP interactions. And as AML professionals, we need to adapt our monitoring tools and investigative practices to detect indirect signs of unhosted wallet usage, particularly around withdrawal patterns, volume spikes, and wallet clustering, for example. And to close this section, let's look at the geographic dimension of crypto-related risks. An area that's gaining increasing attention from regulators and intelligence agencies alike. We're seeing certain regions emerge as crypto risk hubs, not because of innovation or adoption alone, but due to regulatory gaps and political instability and weak oversight. Two key regions stand out here right now. are Sub-Saharan Africa and Central Asia. In many parts of Sub-Saharan Africa, crypto adoption is driven by necessity due to currency volatility, limited banking access, and high remittance fees. But this same environment is fertile ground for illicit access, especially in conflict-prone areas like the Sahel region. Here, terrorist groups have begun accepting crypto donations via third-party fundraising platforms, bypassing global sanctions and traditional financial challenge. In Central Asia, we're observing a different but equally troubling pattern. Fragile governance structures and patchy AML enforcement have made the region attractive for shell NGOs and fake charitable fronts. These are used as crypto channels for extremist fundraising and illicit financial flows, often hidden behind a veneer of legitimacy. The challenge is that these activities often take place just below the regulatory radar. Transactions are small, platforms are decentralized, and the actors involved are transient. But taken together, they represent a growing systemic risk, not just to local economies, but to global financial stability and security. And to respond to this growing risk, we need targeted region-specific strategies. That means capacity building, technical assistance, and intelligence sharing with local authorities. It also means integrating geographic risk indicators, dynamic geographic risk indicators again, into crypto compliance frameworks, something that's still missing in many institutions today, by the way. Because while crypto is borderless, risk isn't evenly distributed. And if we ignore the geographic hotspots, we leave the door wide open for its exploitation. All right, now this is it for now for the new and emerging trends in financial crime typologies. Now I would gladly pass the microphone to Faisal with his perspective on how technologies could help us in navigating these challenges.
Thank you so very much, Andrei. Thank you. A lot of amazing information in your section. For those of you that want to go back over it again, after the session is over, you're going to receive an email with the content that we've talked about here today. So you'll have a chance to go back again over what Andrei spoke about. I'm going to be taking the direction of our conversation right now closer to what the theme is some of the sort of innate difficulties and sort of clashes that you see between the very traditional sector, which has always been an historic banking, and the new sector, which has vast been crypto. My experience in cryptocurrency goes back to 2012. I was a compliance officer for a cryptocurrency exchange in San Francisco for an exchange called Buttercoin. And I worked also very closely with our banking partner back then. And so it's been interesting seeing the evolution of compliance over the last sort of 13 to 15 years in the crypto sector, but also in the banking sector. So that's been very interesting to see. Now, if you speak to banking compliance officers, one of the things they'll always mention is if their firm's policy is to not accept cryptocurrency transactions in their flow, they have sort of a requirement to be able to make sure they monitor said transactions because it would be against their risk appetite. On the other hand, there are certain banking customers on the other end that are actually building products or partnerships to be able to offer some type of services that relate to cryptocurrency to end users. And then in the middle, you have the vast majority of banks, which is they are very aware that their end users are interacting with other crypto and vast companies for services. They don't offer any crypto products themselves, but they also are sort of not, closing down accounts necessarily belonging to people that are working with crypto. So they have sort of this middle ground where even for their own anti-money laundering program requirements, they still have to monitor their internal transactions for said risks. And so what we're going to be doing here is showing you from the technology side how our system is used by banking compliance officers to be able to review transactions that they would see inside of their their banking core, identify the ones that are related to cryptocurrency, and then how to be able to review the risks from a banking compliance officer's side, and then how to go about it, right? So once you've seen it, what exactly do you do with that information? So that's the angle I'm going to be taking, is really what a banking compliance officer should do, or how its system should perform when it's reviewing banking transactions that have to do with crypto-related activity. Okay, so I'm just going to quickly share my screen right over here. Andrei, can you give me a thumbs up if you can actually see the screen and my slides? Perfect. Thank you so much. So we're going to do two sets of transactions. This is the first set of transactions. We have two here. And this is what generally a banking compliance officer would see, right? So they would see a wire transfer that's destined for a certain company name. There's some detail, but not really much. And so that's sort of the basis of this one, right? Now, the bottom half here is what the bank might have already present in its risk assessment. And then the second transaction is a similar one, but there doesn't seem to be much details about this customer in the previous risk assessment. These are the main scenarios that banking compliance officers will actually see a lot. And this has to do with the on-ramp, the acquisition part. So these are customers that are either sending funds or purchasing cryptocurrency or liquidating, but really just the on-ramp experience. Okay. Now, what patterns they're looking for are generally in these three categories. First, you've got wire transfers to MSBs. You've got high value debit card or intrabank payments in the US, that's referred to as ACH, and any other type of unusual jurisdiction wires that the bank's risk assessment had not already seen for its customer. And the reason why these patterns are sought out for is because they generally are sometimes precursors to criminal typologies. So wire transfers to MSBs or payment processors, generally from a bank's point of view, is seen as a very high risk one. A lot of times the reasons for these transactions are not really well detailed. And so because of the opacity in those transactions, it's very difficult for a compliance officer to sort of manage the inherent risk. The second is high value transactions. Most of sort of retail banks generally have mostly customers that engage in retail transactions, which are quite small and quite frequent. So having sudden high value transactions is a big red flag for a banking compliance officer, and it really makes them sort of interrupt transactions quite a bit. And then finally is same thing about the risk of their retail customers, unusual wires or wires to jurisdictions that they have not already accounted for in the profile raises alarms for them and requires them to sort of take a closer look at. So these are the patterns that banking compliance officers look like. So previously, as you saw, these are transactions they'll see, and traditional systems will really just be very monolithic and also just look at single variables. So it'll either look at the amount or just look at the country, and then the compliance officer has to use their own knowledge and time, if they have, to then decipher the rest of it, have to look at it manually with regards to the risk assessment and so on. So we're going to use sort of our platform as an example, but this is how bank compliance officers should think about when they're reviewing crypto-related transactions. So ideally, your system will want to flag a few things off the bat. First, it needs to flag out the fact that the country itself that the transaction or the beneficiary recipient is party to, as well as any other type of intelligence that lets you know that, hey, by the way, this is not just any company, this happens to be also a money service business. Right. So a lot of the lists about if a company is a money service business, an acquirer, payment processor, these are all publicly available. So that type of intelligence needs to be provided that needs to be accessible to a bank compliance officer's transaction monitoring, so it can actually pick up that data and let them know. It should also provide some amount of insight on the notes that show up in transactions. So, for example, the note of service fee is a very ambiguous one, and there are millions of transactions that go on. So, a bank compliance officer needs to be sort of alerted that, hey, there's a very ambiguous note. You need to take a look at this, or there's something in the note that requires your attention. And the reason is very simple. MSBs generally facilitate a lot of over-the-counter transactions. This has some amount of opacity because OTC transactions don't generally follow the agreed upon on-ramp or off-ramp process that a VASP would have. OTC transactions are also high value. They're quite informal, right? So OTC transactions happen really sometimes over chat. A lot of times because of the profitability of OTC transactions, sometimes due diligence steps are skipped quite a bit. Because they also represent quite amount of volume, OTC transactions also end up being sort of categorized, and probably the diligence happens a lot less than would be through a regular onboarding on the VASP itself. And those of you that are VASP compliance officers know what I'm talking about. But that information is not available to a bank compliance officer. So it's helpful for a bank compliance officer to know, okay, this is likely to be an OTC related transaction. So I should know that even if it's going to a VASP, perhaps that VASP hasn't completed its own onboarding, or perhaps it's not as robust as it generally would be for the actual, through the front door on-ramp process that it generally has. Then another thing that a bank compliance officer would want to know is things in the note. Have they been shown to be risk indicators? And sure, so we used a pretty simple example here, which is service fee. And service fee generally has to do with the fact that, businesses that provide either or have a service fee generally accompanied by invoices, some contract numbers, service contracts, and so on. So that information should be easily accessible. And a lot of times, and it's been shown in a lot of documented scenarios where criminals are going to be using very opaque related memos like consulting, subscription, and so on. Now, the interesting thing is legitimate individuals also use opaque memos, and they just say consulting or subscription. But it allows at least the bank compliance officer to be flagged and say, you should take a look at this memo. It's very indicative also sometimes of high-risk behavior. And then finally, another thing is about country. So a compliance officer or bank compliance officer, when they see this transaction and they see the geography that is associated with, are not fully aware of whether that country has regulated frameworks for VASP-related institutions. So providing that intelligence while monitoring transactions of saying, hey, this is a crypto-friendly transaction. In this country, there are licensing needed or there are frameworks needed is very valuable for a bank compliance officer because they can now review this transaction in that context. Whereas if it was from a country that generally doesn't have much regulation or framework with regards to VASPs, it should throw a red flag in the full context. Okay, so these are sort of a couple of things that and I'm speaking here directly to banking compliance officers, your transaction monitoring system should be able to do. Let's go on to sort of the next stage, which is the layering stage. And all of us that are in the AML space know about the 3 stages of money laundering. This one generally is the layering stage. And so these are a couple of sets of transactions, and you can expect a bank compliance officer or an acquirer more likely, or a processor to have that happen, right? So they might have the first transaction here on the left, the second one, and the third one. So it looks fairly innocuous, right? If you look at the amounts, and generally legacy and really old transaction monitoring systems are not equipped for multivariable analysis, and they're really going to pick on one single item. And even traditionally and by habit, compliance officers also do this, where they're just going to look at like the amount. So if you look at the amount, they're not exactly very big amounts. They're quite small. So it's $1,000 there, $500 there, 250, 3,000. But if you have a proper and sophisticated transaction monitoring system integrated into your banking transactions, a lot of information that can come up for you to be able to make a reasonable decision as to whether or not this requires further review. So what are the patterns that came up in the last set of transactions? Well, first, you've got gift and prepaid cards. There has been typologies where certainly these cards are used for a lot of conversion and unregulated P2P cryptos. P2P micropayments are also a usual usage for the legitimate sphere, but at the same time are also used for quite a bit of illicit flows. And then finally, round dollar transfers. Round dollar transfers generally happens to be also a usual indicator in illicit flows as well, just as they do on legitimate flows. So that's why knowing that they exist in illicit flows is really important, so it can help the bank compliance officer do a wholesome review. So now let's take a look at what it looks like when you actually have a proper transaction monitoring system that's reviewing your banking transactions, that is equipped with sort of crypto and VASP analysis. So on the first transaction, right, it spots out that it's Amazon gift cards or transaction handles that have to do with that. This shows up something. Why? Because generally acquirers as well as processors will allow for that purchase. And then if you see other transactions to prepaid Visa cards and you either are a Visa or MasterCard direct member, you'll have the accompanying MCC code. And so that might not mean something to a bank compliance officer, but we can give them intelligence saying that, look, this MCC 6540 has to do with store value instruments, right? Store value instruments or other types of MCC like 4829. These have to do with money order type transactions. And these transactions happen to be very preferred for transactions that are leading into crypto-related transactions. That now provides a bank compliance officer a lot more insight into, okay, now I'm fully understood that this has to do with crypto-related products. Now I have to determine whether or not this is in my appetite or not. The second one, right? So for example, it's going to see, so, to a company, CryptoBuddy SS, the amounts are pretty small. There's a note that they might not recognize. So this allows the SIS system will allow sort of a bank compliance officer to say, this looks like it's a peer-to-peer transaction because a lot of times you have multiple transfers. There are a lot of different apps that have these type of handles and so on, and they have memos like minor fee or ETH swap. And this allows now the bank compliance officer to understand, okay, this user was actually trying to engage in a crypto conversion. So they're probably converting sort of some amount of money for Ethereum. Now, the reason why this would not show up in a regular transaction monitoring system is because a lot of times the variables are not made correctly to all these different variables and are just looking at amounts or thresholds. And you can see here that these type of flags or yellow flags, if you want to call it, want to be shown to a bank compliance officer because their threshold for compliance is so much higher. And then same thing, a little bit of a simpler one on the third type of transaction. You can have a single large amount goes to a certain company, no invoice in there, right? And then there's a wire transfer associated with it. This allows for information in a very simplistic way to go to a compliance officer that, hey, these are round value and the beneficiary names generally have to do with these type of providers, but you should also know that there should be an invoice attached to this because these have related transactions. This allows again, at the end of the day, bank compliance officer to be fully informed when it's deciding on its transactions. So that's generally what I wanted to show on how we help our banking customers review VASP and crypto transactions. And now for us, it's really interesting to work on these things because we actually service both banking customers with AML technology as well as VASP customers. So it's helpful for us because sometimes we put them together, right? They're using a common system. And we know that the compliance officers in both of these institutions have the similar mandate and are looking at things the same way. They're just looking at sort of halves of the actual story. But by putting all of the data of that story together, it allows really the banking compliance officer and the VASP compliance officer to be able to look at the full story together because they're both on the same side. They're serving customers differently, but they're both on the same side trying to deter and detect illicit crime. So hopefully this was helpful for all of you to take a look at and see exactly what's happening here. For those of you that are banking compliance officer, feel free to reach out to us after and we'll be more than happy to chat with you. For compliance officers and VASP, reach out as well. We'll be able to show you how we help you as well. And with that, I'm going to pass it back on to Victor. You are in a treat. He's a real life bona fide. That's not an avatar, as good looking as he is. It's a real human. And he's going to be able to tell you how he sees this spec from someone who is a banking compliance officer with a ton of experience. I'm looking forward to this.
Thank you, Faisal. It sounds more like a fairy tale when you showed what your system can do, because now we are going back to the reality, what traditional banks can see while they have customers who are transacting with VASPs. So let me share my screen. I will start my presentation. So give me a sign that you can see it, Andrei, with your voice, please.
Yes, Victor, you can continue. We can perfectly see and hear you.
Okay, thank you very much. So the topic is how can traditional banks manage cryptocurrency risks without blockchain analytics tool? And what is the main challenge? So Andrei, you also mentioned that it is a growing reality, and we can see that from our practice. More and more customers, they are starting to transact with virtual asset service providers and creating additional risks for the traditional banks. On another side, we also have regulatory demand, and because each regulator, at least in EU or in the Baltics, they expect us to have robust controls on our customers who are transacting with VASPs. And existing tools that traditional banks have, they are related to SWIFT and SEPA payments, and crypto-related payments, they are excluded from there. So this is the challenge that we really have at the moment. But before we go deeper in how we can manage those risks, I wanted to show you an example of the wallet account statement that usually comes to us on the AML table for analyzes what really is happening on the account of our customer who has a wallet in some VASP. Just recently we got another one, and it was without the description, so we only had transaction hash, date, and 2 wallet numbers, and that's it. So if the staff don't have knowledge, if we don't have proper resources, it is very hard to read or even to ask something from the customer to provide to us that we can mitigate those crypto-related risks. But what can traditional bank do? First, and the main one, in my opinion, is to develop transaction monitoring scenarios. And the first step could be that traditional banks will include those abbreviations and the words which are related to cryptocurrencies. So BTC, ETH, crypto, token, etc. And the second one, what is more complex, to include into the monitoring system was bank accounts. The next one, of course, to identify regular round figure transactions. It can be, it depends on the customer type, of course, and from another side, if it is only rule-based scenario, it can perform a lot of false positives. So we need to be smart, and we need to somehow to connect those different scenarios in our monitoring systems. And the next one, unusual transaction patterns inconsistent with customer profile. So if the customer is transacting inside one country, then rapidly he's starting to transact with the other country or transact with VASP, buying crypto or different crypto from different providers, and multiple small value transactions with similar amounts. So this is also an indicator that the customer is starting to transact with VASPs. So let's try to understand what types of transactions do we really have. So the first one, activity, exchange activity, investment services, wallet transfers. So they three most usual one, or the most common one, that traditional customers in our banks can have. So exchange activity, customer deposits to Coinbase, Binance, Kraken, showing references like BTC purchase or crypto deposit. An example, it can be something like 500 euros transferred to Coinbase with consistent partners. Then the next one, investment services. It's larger transactions, so usually they are, and to crypto investment platforms or decentralized finance services. So those are more likely in 10,000s of euros with different reference like savings, investments, and etc. And the last one, wallet transfers to personal non-custodial wallets, can be also done via OTC services, like an example, so payment to Ramp network with reference ETH to MetaMask. But let's see what is high crypto transaction indicators and how traditional banks can identify those. So the first one, transactions with non-weak KYCs, VASPs, rapidly increasing transaction volumes to crypto services, which we were talking about before, references suggesting privacy coins or mixing services. This is what Andrei was talking about in the beginning. Transfers to P2P exchanges without regulation, multiple small transfers just below reporting threshold. It depends on the jurisdiction, of course, or the bank itself, and transaction with references to trouble mixer, anonymous, or something similar. Due diligence strategies. So, and this is very important, as I told you before, the staff, AML staff who are checking those transactions, they need to understand what to ask. The first one, and as I show you as the example of the wallet statement, usually it's not enough. It is better to ask a screenshot from the cryptocurrency exchange platform where you will see more convenient view of how the funds of the customer were or are moving. Of course, blockchain transactions, and you need to ask from the customer why he or she is doing that, or it, if it's company. So as an example, customer sending 5,000 to Binance, and you need to request the proof of destination wallet ownership. The next one, update customer profile. So if you see that the customer is transacting a lot with VASP, then you can, of course, increase the risk of this customer. Then you will have better control of its transactions. As an example, monetary frequency for customer is increased with 40% plus transactions to crypto exchange. It can be 40, it can be 30, it can be 50. Everything depends on your risk appetite. And the last one, verify VASP legitimacy. So it is very manual, but now we already have several providers in the world who are providing this list of VASPs who are approved, so who gain or is gained by the license from the certain jurisdictions, or who are restricted, so who are bad players on the market. As you can see, examples of Coinbase is MiCA compliant and versus unregistered platforms. The roadmap, it is very brief, but I think the main part of it, or the more important part of it, is number one. So what kind of immediate action should traditional bank perform to better manage risks coming from transactions with VASPs? Transaction monitoring rules. So the first thing which we touched upon, train staff to understand common crypto transaction patterns. So what is it and what we need to ask to mitigate the risk or to identify high-risk transactions. And the database with risk classification based on EU guidelines. The second one, medium-term, crypto-specific customer risk assessment framework. But it also, it's very hard to implement right away, but you can segregate those customers to another group and to have more scrutiny on them regarding their transaction patterns. Implement enhanced KYC questionnaire. So it is also an option, and via those questionnaires, you can ask the customer for which kind of purpose they are using exchange platforms, or why they are buying those cryptocurrencies and what kind of cryptocurrencies they buy, because it's a huge reference or huge difference between cryptocurrencies, which can be very transparent or others very anonymous. Establish periodic reporting on crypto exposure for the management and, if required, to the regulator. And long-term strategy, which could be a part of what Faisal told. So you need to implement robust systems to identify those transactions. And if it will be very efficient, you will save resources investigating this type of transactions which are made by your customers. Develop industry information sharing protocols for cross-border cooperation. It is hard, but you can try to do it. Create specialist crypto compliance team. So those are those specialists who are interested in crypto and who are participants in different forums, Telegram channels, and other stuff where they can see the trends, where can they see what kind of WASPs are not reliable, and to update your warning list in your internal system of the bank. And now it is an example of high-risk crypto wallet. So when you have all of these things in place, you can fill out the description of each transaction when or what you can see from the wallet provided by your customer. So it can be transactions to mixers, gambling platforms, rapid deposits from no source. So everything could be asked from the customer in a more concrete way. And on another side, your bank, traditional bank, can manage those risks which are posed by this type of customers. So, and about the identification of risky crypto exchange transactions, again, public intelligence sources. So check the registers, FATF, national regulators. I will show you example about one guidelines which were provided by the Bank of Lithuania, our neighbors, on how to determine customers' source of funds in the crypto transactions. It is very interesting, and it was recently published by the regulator. So media and enforcement alerts, track news, as I told previously, but the person should be interested in the crypto sphere overall. Subscribe to law enforcement bulletins highlighting VSP under scrutiny. So those people or the team who will be dealing with the customers transacting with VASPs, they need to check local registries or the registries of the countries from where your customers are to fill out the list of the VASPs who are licensed already. Industry watch list. You can monitor GitHub repositories by Transparency Initiative. You can, again, scam forums, Reddit, Telegram. Like, information is available, but you need to get it and to structurize it in your local system. Beneficiary tagging. So if you can get payment references, so if you can get IBANs of those VASPs, SWIFT codes, you can put it in your WASP watch list. Then you can flag the transfers if it's like, okay, VASP for you, correlates with your risk appetite. If it's not, you can decline the payment online. Then velocity and volume patterns. What are the spikes from where you will check those alerts? Or it is just, or if you want to identify structuring, as it was previously showed by Faisal, so a series of sub-threshold transfers should be recognized or identified. And of course, it depends on the jurisdiction, but here I have an example that you have 10 900 euro payments just under 1,000 review limit. Round figure and sequential amounts. So round transfers, which coincide with entry or exit point of exchange. And if you want to detect increments, then you need to have, or you need to build up monitoring scenarios when the customer is making 1,000, today payment 2,000, tomorrow 3,000, the next day, and so on, to prevent layering attempts. Cross-channel correlation, which we touch upon a bit, but of course, we need to do all of these things. Sanctions and political exposed Persian databases. So of course, we need to check those not only against our customers who are transacting in our bank, but also all the virtual service providers, identifying do they have in the structure, ownership structure, PEPs, and what kind of PEPs do they have, and what about our risk appetite? Do we want to have that our customers will be transacting with the VAS which belongs to this political exposed persons from certain countries? So we are getting back to the sanctions risks. Block explorers and address registries. So when customers provide transaction hashes, manually verify destination addresses on public block explorers. By the way, there are different public block explorers that you can use if you get transaction hashes from your customers, and they will show you how risky this transaction was, and you can see how risky is your customer or what he or she or it is doing with the cryptocurrency. Then GitHub hosted WASP list, again, crypto enforcement networks. Participate in webinars, in regional FIU-led crypto forums. So, or the regulator who is regulating locally WASPs, and you will get a lot of information regarding how they are licensed. So, and who are not licensed, do we have like a trend where a lot of unlicensed WASPs are operating in the market? And this is the example of the guidelines which were published by the BOL, so Bank of Lithuania. You can easily find it from open sources. This is just a short snap that I made for this presentation, and they have 4 steps how to determine the origin of client funds derived from crypto assets. So very interesting read, and only 5 pages. And here I have 3 last examples how world's leading banks implemented risk mitigation actions on the customers who are transacting with WASPs. So let's check BNP Paribas example. The first part, they built watch list of known crypto exchange account identifiers. So example, IBANs, SWIFT codes, payment references, and fed this into the existing sanctions APEP screening system. So they were able to stop or block those transactions online, or are able. Transaction monitoring rules configured to flag any outbound transfer where beneficiary reference contains an exchange name or wallet tag. And the last one is about due diligence. So each bank have a certain threshold from where they will stop the transaction and put the customer on enhanced due diligence and ask the questions. So in Paribas, it's something like 3,000 per month to such beneficiaries. The next one, Santander, VSP taxonomy. They developed, and this is very interesting because they connected it with their own developed scoring based on their own risk assessment of different WASPs. So they took 40 crypto platforms, rating each by regulatory jurisdiction the first, publicly disclosed AML control, so they were not doing by themselves, so they are not able to do that. AML audits, external audits, and all the reported hack history. Then assigned each outbound payment a composite risk score based on the target exchange profile and the customer history transaction. So they had or have very interesting approach and very complicated scenario, not only connected to the exchange itself, but also taking into account customer historic transactional patterns. And automated escalation, it is based not on the sum transaction, I mean the transaction sum, but on this risk score. So any transfer crossing a score threshold tier 2, medium high, or above is automatically routed to manual review by FinCry team. And the last one, Citigroup, for this type of transactions, they have 2 or 4 eyes principle, and it is divided, as you can see, by different thresholds. High level alerts, a single transfer above $50,000 to a VASP will give an alert, and it should be done by 4i principle. Then mid-level alerts aggregated monthly outflows to any crypto destination 7.5K, and the last one, low-level alerts. So single transfers to crypto destinations over 2.5 trigger initial alerts. Thank you very much. This was my part, and hopefully representative of traditional banks gain something new and something they can use in their daily life to manage the risks from transactions with VSPs. Thank you.
All right. Thank you very much, Victor, for your presentation filled with practical perspective and very good insights on how we could tackle this new risk environment in the crypto space, especially from the traditional banks perspective. So thank you for this valuable presentation. And now we'll switch to the Q&A session right away. We're going a little bit over time, but I think we can spare some time on this valuable part of our events. I will start with the first one, with the first question from Franco. And Franco asks, what rules or restrictions you may apply to dormant accounts to avoid risks of money laundering and terrorist financing? And also, what do you suggest may be considered as dormant? Time frame of several months without activity, maybe other type of variable factor. So I will answer this very quickly. So basically, to mitigate financial crime risks, dormant accounts should be subject to transaction restrictions, firstly. Secondly, re-verification of customer identity before reactivation, and enhanced monitoring for unusual activity. If there are, for example, large transfers right away from the dormant account, for example, or to some unknown addresses. An account, answering the question regarding the time frame, an account may reasonably be considered dormant after 6 to 12 months of no customer initiated activity, depending on your internal risk appetite as well. And the risk-based approach, such as logins or transactions to this dormant account. However, dormancy should also factor in behavioral and risk-based indicators. For example, failed contact attempts or unusual login patterns from other jurisdictions, unknown jurisdictions the customer previously weren't, or sudden reactivation after prolonged silence. So this is to answer this question regarding the dormant accounts. All right. I see that Faisal also answered to one of the Franco questions in chat. I hope everybody could see it also open.
Yeah. Franco had one of the questions, which is a really great one, by the way, which is, what is the minimum amount of information that I need if there is an EDD request specific to a regulator inquiry? And so the first question I asked him back, and I don't know whether he's answered back after, is which jurisdiction? Because the EDD thresholds really depend on which jurisdiction itself. It's very dependent. It's never the same. So knowing that is really important. But they can always reach out and we'll be able to dig through our repo and find out. There's a really good one here. I think it comes from Franco as well. It says, do you think it's viable to maintain a specialized team dedicated to monitor closely vast transactional activity within a banking relationship in the banking compliance department? I think I'd like Victor to take a stab at this one.
Thank you. Now, this is the question from Franco, yeah? Do you think it is viable to maintain a specialized team dedicated to monitor closely vast transactional activity within a banking relationship in the banking compliance department? It can be a specialized team, as I mentioned before, but it also can be just one expert who will be fully dedicated to, first of all, to check on daily basis all the trends related to VASPs, checking all the forums, all the different groups on Reddit, on Telegram, checking regulatory letters or typologies that they put on their homepages regarding cryptocurrencies. It depends on the resources. How many resources do you have? Of course, it can be automatic system that can do it, but I think the person will be more convenient, and especially if he or she has a huge interest in this industry.
Yeah, I agree with that. In our experience, what our banking customers do is very similar to what Victor said. But I think the one thing to keep in mind, Franco, is that a bank will want to invest that type of resource in two situations. One, if the amount of flow that they get or the customers that they are working with happens to be somewhat of a material amount of customers that they actually provide services for, then it makes sense to have individuals operationally. And I think one of the things we all forget a little bit here is that the amount of crypto transactions worldwide as a proportion of total financial flow worldwide is actually kind of minuscule. I think the total amount of funds that flows globally in crypto is a few trillion, whereas the total amount of flow per day is a few quintillion. So the proportion of crypto flow as a basis of total worldwide flow is quite minuscule. And unless a bank is actively servicing vast customers where it's part of their actual, customer category, operationally, it's not profitable for them to even assign much resources towards that, which is why a lot of times you're going to notice that banks will actively sort of deny or transactions related to crypto or even close it or so on, because there's just so much more transactions that are non-crypto that are more risk for them, that are more profitable, and just mean more for their overall business. Which is why probably what banks want to do is upgrade their systems to be able to still flag the red flags and alerts related to cryptocurrency, because the one thing that is true is that even the percentage of illicit activity as a total of all crypto activity is a few percent, in terms of total proportion, the amount of illicit activity in crypto is about 3,000 times more than the amount of sort of, illicit activity as a total of worldwide financial flow, which is a few quintillion. So proportionally speaking, putting a human resource just is very expensive, especially in the day of AI and technology. So probably banks are better served, if it's not part of their actual operations and so on, to update their systems to look out for that increased risk rather than actually putting in resources for it. So that's sort of my take on that.
All right, thank you very much for that comprehensive discussion. Then I also wanted to cover one question from Franco. He actually asked a lot of questions, was one of the most active, I think. But next we should answer some further questions from other participants as well. But really answering this very briefly regarding the Wolfsbeck questionnaire, while it is not applicable for VASPs, to everyone who is not familiar with the Wolfsbeck Group Correspondent Banking Due Diligence Questionnaire, is a globally recognized tool used by financial institutions to assess the AML controls of their correspondent banking partners. But while it is tailored for correspondent banking, I still believe that applying the Wolfsbeck questionnaire, even though it's not directly tailored to VASPs, can still be a valuable tool under regulatory supervision, because it offers a globally recognized framework for assessing a counterparty's AML controls, governance structure, risk management, and etc., all of which is very important when dealing with virtual asset service providers. And by adapting this questionnaire a little bit to your internal risk policy and to fit the specific risk profile of VASPs, such as including questions on technology controls, travel rule implementation again, wallet screening, any other tools they use like blockchain analytics, etc. It helps build a robust EDT processes. You can also, for these purposes, use the FATF guidance on VASPs. While it's not a questionnaire, they outline key risk indicators and AML CDF requirements that can be turned into a due diligence checklist. And the topics include, if I'm not mistaken, licensing and registration, ownership and control, compliance with the travel rule, again, AML program structure, the technology used, and etc. Customer due diligence practices and their policies, and etc. So yeah, adopting this to the VASP's reality is very important, but you can use any other checklists. All right, who else? More questions? Maybe Faisal or Victor would like to answer the question from Maria, who asks, can you recommend reliable VASP databases or risk intelligence providers that align specifically with EU AML guidelines and offer dynamic risk classifications to help banks and auditors effectively implement a risk-based approach in onboarding and monitoring crypto-exposed customers?
I'll let Victor take a first stab at it.
Yeah, so I cannot promote like any system here at the moment, but you can search it by yourself. As far as I know, again, from the practical perspective, each bank in the Baltic at least they're trying to build up their own list and trying to monitor it. But
Yep.
as I mentioned previously, so you can try, but how many of worldwide VASPs will be used by your customers for transactions in certain region? So this is like the main question. That's why everybody is building their own lists regarding the region where or jurisdiction where they operate.
That's exactly right. In fact, if you look at sort of companies that specialize in crypto monitoring, or KYT provider, sometimes it's called, they each have their own sort of product that they have, which is called counterparty risk assessment. And if you look across all of these crypto KYT providers, there's some overlap in there, but there's also areas where there isn't much overlap, where it's some unique. And the only way they were able to create that counterparty risk database, if you want to call it that, it's because they observed and got feedback from their customers when they were engaging in that. So a lot of that database was created by them, by being very attentive and listening to their customers and taking feedback and building it. There isn't, Franco, if who was it? Was Maria? Maria, if someone tells you that they've got the quintessential database for it, they're lying. Doesn't exist. It's really built sort of individually. But I also don't think you should look for that. What I think you should look out for is, what is a good set of criteria that you need to collect and evaluate when you are reviewing any VASP. And I think that's a much better approach to take, because even the counterparty intelligence that these companies created was based on their scope and the transaction, the feedback they got from their customers. And we all know that each financial institution's risk action is dependent by its own personal risk appetite. So rather than take that, just create a criteria and weightings on how to be able to evaluate a VASP. And then once you get a VASP, put that into your evaluation criteria, and you've got one that's just for you. And then you can modify that criteria as you get more information, or we get better as a community on learning about this. And then it automatically updates the criteria for all of the VASPs. We at Complytek, we just built it because we felt like it, but we have a matrix for the different variables when you want to evaluate with a DEX. So some of our VASP customers that deal with decentralized exchanges have a red flag for whenever there's transaction with the desk, which I understand why. But not all DEXs are equal, right? There is actually some DEXs that are pretty viable to work with. So we create a sort of like a criteria sheet that you should evaluate and use as to, is this a DEX that I want to work with, and then proceed that way. So we're happy to also distribute that. Not a problem. But that's my suggestion, is don't look for the database because they are curated in a capitalistic way. It's better for you to create the criteria and then evaluate it by yourself.
Yes, completely agree with you both. Thank you for answering this question. Maybe we should answer one more from another participant and then call it a day. And probably if I see that Simon is asking about how Complytek use AI in AML checks, it is for you. I think you could answer this during a call or an email. All right. I would like to answer one question from Stelius, and you could support me, guys, answering this one as well, regarding what key risk factors and considerations would you assess in transactions conducted via a crypto swap entity. So when assessing transactions conducted via a crypto swap entity, I would focus, and I think that each compliance officer would focus on several key factors. The first one is absolutely, as always, anonymity and source of funds, because crypto swap services often allow asset conversions without formal onboarding. Some of them don't even perform KYC checks, depending on the entity. Travel rule and regulatory compliance. Many swap platforms do not comply with the travel rule or maintain robust AML or KYC procedures. So I would assess whether the entity is registered, supervised, and aligned with global standards and local laws as well. So a whitelist of crypto swap entities here is also very important, as with regular VASPs. Also, blockchain analytics signals, I believe. I would use blockchain analytics tools to check links to illicit wallets. You can do this check manually if you like. And jurisdictional exposure as well, which we have covered previously. The location and the legal status of the swap provider matters a lot here. All right, something to add, Victor, Faisal? What do you think? Or you are satisfied with my response?
I like it. That's good.
All right, thank you very much. All right, I think we've come a little bit over time, 15 minutes over time, which is great. Again, everyone, if you have any questions left after this training session, so something unanswered, you can reach out to me or Faisal or Victor directly through LinkedIn and ask your questions there. And as always, you can participate in another webinar with us in Complytek, where we'll answer those questions to you guys. So wait for your certificates of attendance, and see you next time, guys.
Thanks, everyone.
Thank you very much, everyone. Thank you.
Thank you.
Thank you very much, guys.